So what if the very foundation of our financial world isn't nearly as solid as we all think it is? Today, we're going to unpack a pretty controversial theory. It's called the Great Taking, and it argues that there's this massive, hidden risk baked right into the system, and that a huge transfer of wealth could be on the horizon because of it. Let's dive in and see what it's all about.
Right off the bat, this is the central question the theory forces us to ask. I mean, we all just assume the answer's, yeah, of course they're mine. But the argument we're exploring today suggests that because of some really subtle but pretty profound legal changes over the years, the real answer might actually be no. And that would have some absolutely enormous consequences.
All right, to get our heads around this provocative claim, the people behind the theory say we've got to rewind the clock. They argue that the very first crack in the foundation appeared decades ago, during one single pivotal moment in financial history.
For proponents of this theory, 1971 is ground zero. It's when the U.S. cut the dollar's last tie to physical gold. They argue this didn't just tweak the rules, it completely flipped the game board. The system was no longer anchored to a real, physical asset. Instead, it was anchored to something totally different, the U.S. government's promise to pay its debts. And that made U.S. Treasuries the bedrock for everything.
And this really shows you the fundamental shift they're talking about. The old system was based on gold. Gold is just gold. It's an asset that isn't simultaneously someone else's liability. But the new system, it's built on treasuries, which are debt. They're IOUs. And this, they say, introduced a critical flaw that never existed before: counterparty risk. All of a sudden, the world's safest asset was only as safe as the issuer's ability to pay up.
And that leads to the theory's most blunt criticism, which you can see in this quote from one of our sources. The argument is kind of terrifyingly simple. If the entire global financial house is built on U.S. government debt, what happens when the issuer of that debt is the biggest debtor in the history of the world? From this perspective, the whole thing is just a house of cards, built on a foundation of sand.
Okay, so you might be thinking, if this all kicked off back in 1971, why the sudden, urgent panic now? Well, the people who subscribe to this theory claim it's because those cracks in the foundation are finally starting to spread, and they point to a few very specific recent events as proof.
According to this view, the first really big tremor was the freezing of Russia's reserves. This apparently sent a shockwave through the rest of the world, a clear signal that said, hey, all those dollar assets you're holding, they might not be yours if things go south. The theory claims this is the direct cause for what we're seeing now: central banks scrambling to get their physical gold back home, and a massive spike in demand for actual, physical gold and silver from the exchanges.
And this number gets to the heart of what they call paper market risk. It's wild. On an exchange like the COMEX, for every single physical ounce of silver sitting in the vault, the sources claim there are over 300 paper contracts or claims for that same ounce. 300 to 1. The fear is a classic bank run, but on the exchange. A failure to deliver that could just shatter market trust in an instant. Now, layered on top of all of this, you have the derivatives market. You can think of these as basically side bets on the performance of other assets. The theory we're exploring sees this market as the ultimate house of cards. Some estimates put its value at over $2 quadrillion. That's a 2 with 15 zeros. It's a number so big it just dwarfs the entire real economy. And it's all balanced on that same shaky foundation. And this right here is what proponents see as the final trigger. In a market that's this tangled up and interconnected, they argue it only takes one major player to go down. Because every single bet is connected to another player's bet, one failure could start a chain reaction, a cascade of defaults that just rips through the entire system like wildfire. So this whole chain of risk, the sandy foundation, the paper markets, the derivatives, it all brings us to the absolute core of the theory, and where it gets its name, the Great Taking. This is about the alleged legal trap quietly put in place that they say would kick off a historic wealth transfer during a crisis. So what is the Great Taking? Well, the theory hangs on a truly startling claim that modern financial laws have fundamentally changed what it means to own something. It asserts that the stocks and the cash sitting in your brokerage account aren't actually your direct property if there's a crisis. Legally, they're now considered assets of your broker, and you You're just another creditor in line, hoping to get paid. So how would this all play out? According to the theory, it's a four-step process. First, a big financial institution is about to go bust, but instead of a government bailout, it performs a bail-in. And it does this by using its clients' assets, that's your stocks, your bonds, your cash, to save itself. The assets are legally reclassified as the bank's own capital, and just like that, the original owners are locked out, with, the theory claims, absolutely no legal path to get their property back.
This whole nightmare scenario is built on this one concept: counterparty risk. See, because you hold your assets through a middleman, a bank or a broker, you're exposed to their risk of failure. The great taking theory argues that the laws have been changed to basically weaponize this risk. Now, if your counterparty fails, their problem legally becomes your total loss.
To put it as plainly and brutally as possible, this is the theory's bottom line. What all of us think of as our assets have been, through legal maneuvering, transformed into our bank's collateral. Okay, so if this theory paints the entire financial system as one giant trap, does it offer any kind of escape route? Well, its proponents argue that yes, there is one, and only one, lifeline.
The solution they propose all boils down to this simple but critical distinction. Financial assets, your stocks, bonds, deposits, are held through an intermediary, which means they come with counterparty risk. But physical gold and silver, held directly by you, in your possession, they have no counterparty. From this point of view, they can't be part of a bail-in, because they were never in the banking system to begin with. And the argument they make isn't just about safety, it's also about preserving wealth. They point to gold's track record, like you see on this chart, calling it a 10-bagger since 2000. And crucially, they say it comes with no risk. Now, they don't mean the price can't go up or down. They mean there's no risk of it going bankrupt. Unlike a company or a bank, gold itself can't become insolvent. It just is.
And this quote right here, it delivers the theory's ultimate stark conclusion. In a world they see as being full of cascading liabilities, when all those dominoes start to fall, they believe only physical gold and silver, the two assets with no counterparty, will be left standing. So, what's the verdict? Is gold just a barbarous relic from a different time? Or is it the ultimate safe haven in what could be a very fragile system? The great taking theory presents a deeply challenging and, frankly, disturbing view of our financial world, and it leaves every one of us to think about that answer for ourselves.